This flick is a real blockbuster, detailing the gripping tale of three savvy investors who made billions betting against the housing market just before the 2008 real estate meltdown. But how exactly does the shorting game work? Well, in the movie they use swaps, a kind of financial tool to take their positions, but for us regular folks, shorting typically means betting against individual stocks. Sounds easy, right? Well, hold up. There's a ton of risks involved. So here's the deal. When you short a stock, you're essentially borrowing shares from someone else and selling them on the market, hoping that the price will take a dive. If it does, you can then buy back those shares at a lower price and make some sweet profits. But if the price goes up instead, watch out. You can be on the hook for potentially unlimited losses. See, when you short a stock, your potential gains are capped at the amount you got selling those shares, whilst your potential losses are uncapped. So before you take a short position, make sure you're fully aware of the risks. In contrast, a traditional long position involves buying a security and holding it for a while, with the hope that the price will rise over time. It's a more straightforward approach to investing, but it also has its own set of risks. Ultimately, whether you go long or short depends on your investment strategy and risk tolerance. It's a trading strategy that's all about reversing the old age, buy low, sell high. Instead of waiting for the stock price to go up, shorting involves selling high and hoping that the price drops in the future. But hold up, shorting is a bit trickier than the usual going long approach. Let's break it down with an example and see what the risks are involved. Say you have two investors, A and B. The stock is currently at $10. Investor A decides to buy 1,000 shares, putting in $10,000 into the company. Investor B, on the other hand, decides to short 1,000 shares, effectively selling 10,000 worth of investment. But how do you sell something you don't actually own? Well, oftentimes, you borrow the stock from your broker and then sell it with the intention of buying it back later. This is what is called covering your short. When you buy a stock at a lower price, you can return it to your broker and keep whatever money is left over as a profit. So if the stock price drops from $10 to $5, investor A will lose $5,000, whilst investor B will make $5,000 by buying the shares back at a lower price. But if the stock goes up from $10 to $15, investor A will be up $5,000, whilst investor B will be down $5,000. It's important to note that shorting comes with a lot of risks, including potentially unlimited losses if the stock price keeps rising instead of falling. So before you go diving into short selling, make sure you understand the risks and have a solid strategy in place. So let's talk about shorting and margins. Short selling is about betting against the stock's future price and selling high whilst buying low in the future. But what if you don't have the funds to buy back the shares you've sold? Well, that's where margin comes in. To short a stock, you have to cough up an initial margin. Usually it's about 50% of the stock's value to cover any potential losses. So in our example, investor B would have had to have contributed $5,000 of their own cash as a margin. This money is still theirs, mind you, but it's held by the broker as collateral to ensure that investor B can afford to buy back the shares in the future. But be aware that investors will also be subject to margin calls, which requires them to deposit more cash if the margin gets too low. Here's the kicker. Short positions require a margin account. This can be a downside, but it can also supercharge an investor's return. Let me show you what I mean. Say the share price falls from $10 to $5, and investor A loses $5,000 whilst investor B gains $5,000. Both investors have made the same amount of money. Right? Not quite. The percentage returns accounting for margins are different. Investor A has lost 50% of their investment, but investor B has gained 100% of their investment. That's double the percentage return of investor A. But here's the catch. Short positions come with unique costs that long investors don't have to worry about. For example, if the stock you borrow pays a dividend, you got to pay it back to the broker. For example, if the stock you borrow pays a dividend, you have to pay it back to the broker. And there's interest on the borrowed stock value as well that you have to pay. When you're borrowing someone else's security, you're going to pay interest just like you would on a bank loan. So there you have it. Shorting can amplify your returns, but it comes with its own set of risks and costs. If you're considering taking a short position, be sure to know what you're getting into and make sure that you have a solid strategy. Now, shorting a stock can be a pricey move compared to simply buying it. You could be looking at anywhere between 2.5 to 20%, or even more for hard to borrow stocks. But don't worry, These expenses are justified because you're taking a leveraged position and trying to invert the return of a long position. Plus, paying out the dividend received from the stock makes sense. But hold on, there are some serious drawbacks to this strategy that you should be aware of before jumping in. One major issue is the buy-in risk. This is when your broker forces you to cover a position early, either because they need to return the stock to its original portfolio or due to a sudden surge in demand. This setback can be a real blow, especially if you're confident about your long-term predictions and waiting out market volatility. Another risk to keep in mind is a short squeeze. This happens when a heavily shorted stock sees its price surge because those shorting the stock need to cover their position. As a result, the price can spike and make it harder for you to cover your own position without incurring a loss. Perhaps the biggest risk associated with short positions is their skewed payoff. Imagine those two investors again, one long and the other one shorting the $10 stock. They face two different risk-reward profiles. Investor A can theoretically earn an infinitely high return on their $10,000 investment, but Investor B's maximum profit is limited to the $5,000 they initially put into the margin account. On the other hand, if the stock price goes up, Investor A can only lose their initial $10,000 investment, but Investor B can face infinite losses. So shorting may not be everyone's cup of tea, given its unique disadvantages. However, for those willing to take the risk and the time in the market as well, it can sometimes lead to significant returns. Or let's say you've got $10,000 to play with and you're eyeing that $10,000 stock. Investor A wants to go long on the stock hoping that it will rise in value, but Investor B has a different strategy in mind. They're going to short the stock because they're basically betting that it'll go down in value. Here's the catch. With short selling, these losses can be astronomical. If the stock goes up 20, 30, or even 40 or even higher, your losses keep compounding. But also, if the stock drops to zero, the maximum amount you can lose is the money you originally invested, the outset, which in this case is $10,000. And that may seem like a lot, but it's a far cry from the losses you could face if you went long. On the flip side, if you go long in a stock, the potential gains are infinite. If a stock doubles, triples, or even quadruples in value, your investment could pay off in spades. But if the stock plummets to zero, you could lose everything. So why do people go short? Well, sometimes it's because they think a stock is overvalued, or they believe that the company is in decline. Short selling can also be used to hedge against other investments. However, short selling is a high-risk strategy, so it's not for everyone. Short selling also has its downsides. If you misjudge a stock, it could suffer heavy losses. And if the stock is heavily shorted, there's always a risk of a short squeeze. Overall, selling short can be a potent tool in the investing world, but it's not something to be taken lightly. If you're considering shorting a stock, make sure you understand all of the risks involved and always do your research and invest wisely. If you enjoyed the video, don't forget to hit the like button and subscribe for more. And if you have any feedback or suggestions for future videos, leave a comment down below. Take it easy.